So
So
Eric, before you keep going, I'll play a little bit of devil's advocate. We just painted a pretty rosy picture.
yes,
Corporate earnings look good, forecasts look good. Everybody thinks we're doing well. The GDP numbers are great. So let's talk about some things that could possibly derail this, right? And
absolutely.
politics, we'll leave that one to the side because we know there's not really a huge correlation between political policy and what gets enacted and overall stock market returns over a period of time. Again, more of a headline risk or a shock event, but beyond that, there's not really much to look forward to there. But when we're thinking about risk factors going into 2025, maybe you could touch on that, and maybe that's the next couple of slides. I don't want to steal your thunder.
No, absolutely. No, it's a great it's a great point because that's really where we're headed next is that there's good reason for optimism as we head into 2025. And despite some short-term volatility we've seen, good reason for optimism, but that does not mean that we're not without risks as we go through the year. Now, I would say the number two downside risk, so kind of do it in like a countdown fashion. The second biggest risk to the markets as we go through 2025 is we actually get the economic recession that everybody's been worried about for the last few years. I don't have a chart for it here, but one of the things that we have had for the last several years is something that's called an inverted yield curve. And an inverted yield curve is that weird phenomenon where investors can go and get paid more in terms of yield or interest rate for loaning money to the US government for 2 years. So that's your 2 year treasury note. Right now that's in the neighborhood of about 5% or 5.5% versus what they can get paid lending money to the US government over 10 years, which, around like 4.5%, 4.75%. So the question is, well, why would that be the case? The reason that investors would be willing to pay, receive less for lending money to the US government for longer is because they want to lock in that longer term rate. Why would they want to lock in that longer term rate? Because they're expecting that the Federal Reserve could lower interest rates in anticipation of a recession. We've had an inverted yield curve 13 times over the last 100 years before the current inverted yield curve, that phenomenon where short-term yields are higher than long-term yields. Today is the 14th time. And it's been this way for about a year and a half now, but we haven't had a recession yet. 13 out of 13 times in the past it's been right. This time we haven't had the recession yet. So, but if we do get that recession that plays out in 2025, and the reason that would weigh on the stock market is because this positive earnings forecast that we see here, that could flatten out in a hurry if the threat for a renewed rise in inflation. We can all remember what took place in 2021 and 2022. We came off of COVID, and COVID was a shock to the system. And the fiscal policy response from the US government, the monetary policy response from the US Federal Reserve was overwhelming in terms of the stimulus and support that was provided to the US economy. So supportive that it ended up sparking an inflation problem. It had its seeds in February of 2021, and you could watch it all through 2021, as you can see here on this chart. The problem continuing to grow. By the time we're in 2022, we have a big inflation problem in this country. We have headline inflation getting as high as 9%. We have core inflation, which excludes food and energy, getting as high as nearly 7%. So a big inflation problem. And one of the ways that impacted the market and the stock market in 2022, we saw stocks go into a bear market in 2022, and we saw bonds had a tough year in 2022. So a meaningful downside risk. And it's one that, really, in terms of the work that I've been doing, I've been talking about that being the number one downside risk for markets going all the way back to the summer of 2023.